Good morning, everyone. I'm Vince Lancy. This is the Market Rundown. Our title today, tentatively, is 3 Billion Banks Tariff Analysis. Not very exciting title, but very important and very timely. We are probably the first to get and discuss 3 reports out by bullion banks, for the most part, discussing the potential effects of tariffs. We also will be discussing today literally what happened when the tariffs went into effect and how the markets treated them in an attempt to explain the next time it happens. We will also be reading some excerpts from Ross Norman of Metals Daily, formerly Sharps Pixley fame, discussing that it really is potentially business as usual going on in Europe. If you're a trader listening to this, you will get, from trader to trader, proper assessment of what happened yesterday in the markets to better corroborate your own analysis the next time this comes up, if it comes up again, and it will. If you're an investor, you're going to get a lot of good information today, especially if you're in the premium section. It will prepare you for the next news items that come up in this topic and help manage the multiple emotional, uh, the tug of war that we all go through when news comes out and nobody is giving us the answer right away, and we have to wait for markets to digest it and someone who's a little bit closer to the fire to tell us how hot it actually is. Well, I'm going to give you the tools to do that now, so the next time it happens, you can just tell your friends what's going on. What did we learn as geopolitical traders and investors yesterday? Well, we learned that, number one, and we'll go through this today, tariffs are initially bearish for all metals. Number two, tariffs are initially bullish for oil. Number three, tariffs are probably bullish for all metals ex-US pricing, which means eventually they're bullish for metals like gold and then silver and then maybe copper. Base metals, probably not. As the global deflationary impulse kicks in, industrial metals get hurt the most. So gold would probably go up. That's another conversation, but you get the idea. And the next thing, as has been proven for years, tariffs always play out in oil most efficiently. Now, you may ask yourself, what does this have to do with oil? Because this is basically predominantly metals. It has everything to do with oil. Trump cares about oil before everything else, and it is my opinion that oil is why things happened yesterday, or oil is why things closed yesterday in terms of the tariffs ending. All right, let's get right to the actual markets themselves. 10-year yields are 459, up 4. The dollar is up 15 at 108.57. The S&P 500 is down 32, 59.96. The VIX is 18.11, down half a percentage point. Gold is 28.22, up 8 and change, vacillating between up 5 and up 12. Silver 31.69, up 14, holding its own. Copper 429, down 22 basis points. Let me adjust my screen a little bit so you can see the tail end of those numbers. There we are. I'll leave that up for you all. Hopefully you're not here for the production value. Where were we? WTI down 80 at 72.07. It's all about oil. That's what Trump is looking at. Natural gas is 344, down 14. Bitcoin 99 and change, down 1,800. Palladium down 20. Platinum down 1. Grains mixed with wheat actually moving a little bit, down 6 cents. All right, let's start with this since I'm here. 6 markets. We had to bring out the 6 screen today because too many markets being watched. Top left, silver. Middle, top, gold. Top right, S&P. Lower left, currencies. The I didn't put the Canadian dollar there, did I? Well, here we go. The Mexican peso, the euro, and WTI. All right. Now, on the tariff news, the initial digestion of the tariffs being implemented, silver sold off, gold sold off, stock sold off, the Mexican peso sold off, the euro sold off, and oil rallied. And if you are of the opinion that silver and gold and stocks sell off because the world is risking a deflationary crisis, stagflationary crisis, perhaps, but economically the world slows down. Why would oil go up? You don't know why, but it went up. And if you're Donald Trump, you do not like that. Okay, so I'm not saying that he caved. I'm saying that nobody wants higher oil prices. And so the bottom in the V in silver, gold, the S&P, the top in the peso, the euro, and oil all coincide. When the announcements started to leak out that Canada and Mexico came to the table to negotiate in earnest, silver rallied, gold rallied, the S&P 500 rallied, although not as much. The Mexican peso went back to where it was and then some. The euro retraced most of its losses. The Canadian dollar, I think, also went back to where it was and then some. And oil went lower than where it was. This is about oil. It may not have been the reason he did it, certainly not the reason he did it, but the reason it closed is because oil went up. So there you go. It's all about oil. Now we'll get into the actual metals ramifications or implications in detail here. So bear with me while I find that page again. All right. Front page, Zero Hedge, our post. Well, Zero Hedge actually said this. It has nothing to do with Trump tariffs. We agree with them. So what's going on in the London bullion bank market and all the metal that was coming here that has been characterized as getting ahead of the tariffs. Well, it has something to do with it, not to contradict Zero Hedge, but it has something to do with it. It's a catalyst for people to do what they've been doing for the last 2 years anyway. But the tariffs are not why gold is going up. We saw yesterday that the tariffs initially make the buying in gold stop, the silver buying stop, and the shorts in oil cover. All right, GoldFix PM on the left-hand side, we threw a little price target action there. You know, we're not technicians, but there are certain formations that we're familiar with. So we basically say new all-time high in gold. Next stop is 28.90 if we stay above 27.70. So there's your risk. Do you want to risk 50 to make 100? We think it's a good trade. We're not long gold speculatively, we're long silver. Michael Every, Trade Wars, bigger, longer, and uncut. Nice title. Our picture, well, maybe not bigger and longer, but they're not cut yet. All right, we're going to start with Ross Norman of Metals Daily. He used to own Sharps Pixley, and we used to read his stuff uh, uh, zealously because there really wasn't much out there. And at least Ross would put some things out because he was an information broker in that sense as well. We still read him, and we think this is an important piece to read. So we're going to read a couple excerpts for you from it. Ross Norman asks about those London gold shortages. Now, he's going to be counter to what most of the viewers on this channel or station or whatever we're called say. And he's going to offer factual, reasonable explanations as to why things are not as bad as uh, uh, the raging bulls would have you believe. Quick adjustment. All right. London is sitting on about 8,710 tons of gold, according to the latest LBMA vault stats, and the drawdown has not exactly moved the dial. See below. Yes, less than half of this is owned by other central banks, but the majority is ready and available. And he goes on to elaborate on that. He describes the situation, the bottleneck or traffic jam or log jam, I think is the term he used, as a logistical and conversion problem. he says temporary log jams happen, and he goes into that analogously and empirically. The scale and speed of the drawdown in gold has reduced liquidity in the market temporarily, and the cost of borrowing gold has rallied from sub 1% to north of 10%. This has a detrimental impact on gold borrowers. By the way, borrowers of gold in their normal business, they borrow to close deals, and then they uh, send the gold back when they get it. That would be jewelers, refiners. Everyone does things on credit, in metals, and that has been something that's many would say has been abused, and we believe that as well. But it's worth remembering. Little side note: rehypothecation was invented in England for gold longs, not gold shorts. How it's been abused over the years is a different story, but it was invented to let business run smoothly. So leasing has been part of their business for a long time. So yes, the very infrastructure that interfaces with gold consumers and makes our markets possible is being damaged. Now, the implications here are that the damage is being done from the increased offtake in metal. I would say this: Daniel Gali from TD made a comment that not many people have focused on because it was a little bit wonky, but it is a key comment. He said that when you don't have enough available bullion, you risk damaging I think he said microstructure. And our understanding of that is microstructure really is logistics. So if you don't have enough of bullion readily available, then the microstructure gets damaged. Look at the logistics or the supply chain in England or in Europe as a straw. And when you get a little air in that straw, things don't flow through clearly. Natural gas pipeline is a similar analogy. So if there's gaps in the delivered gold, oh, this is supposed to be available, but it's not being delivered, well, you have logistics problems. So I would say, without disagreeing with Ross here, I would say that the microstructure or the logistics are the damage in those systems is manifest now. I mean, has been manifest for years and is being seen now. And the reason it has been allowed to, let's say, get dilapidated is because too many people, it's a crowded trade. He knows what I'm saying. It's a crowded trade. Too many people are borrowing, too many people are playing just in time. And as a result of that, the available bullion is just not available fast enough. The world assumes real time now. The other thing is, all the gold in the world is available at a price. It's not consumed, it's not used. So you have to find the people that are willing to give it to you or lease it to you. And I think things have been taken for granted in the LBMA for years, and why shouldn't they be? But it's a different world, and I think they all realize that now. All right, so anyway, I recommend you read it. It's very good, and it's uh, a very sane take on things. It's not to say that we don't have a problem, but it is to say it's not because we don't have enough gold. We don't have enough gold getting to where it's got to get to quickly for whatever reason. So there's air in the straw, as I would say. So moving on. First takes on tariff risks to precious metals. All right, there are three banks. One is Swiss, one is Canadian, and one is American. The Swiss Bullion Bank says they said this before tariffs were announced, but they are factoring it into their calculus. We believe the metal is due for a revival in 2025 with its price trajectory. This is about silver, by the way, with its price trajectory likely to be anything but gradual over the next 12 months. Robust industrial application demand, around 55% of silver consumption, should combine with rising interest from value-conscious buyers who look to silver as a way of buying into expectations of even higher prices of the yellow metal. So what you have here at the top, that's industrial demand, which is vulnerable to tariffs, right? And down here, what you have is investor demand that's really value, let's call it tracking gold, right? These are people buying the dip. And there's a robust overall silver demand. I think important, they raise an important point that they have not raised for a long time. Stronger supply bears watching. This is the point. But the biggest risk to prices is related to more to President Trump's policies that could be inflationary and the Fed's response via changes to its stance on U.S. monetary policy, rather than any silver-specific news flow in our view. That's right. All right. But stronger supply bears watching. They're discussing that supply is starting to uptick. The needle has moved. I wouldn't call it a trend. It will be the first year that we're budgeted for an uptick in supply. I'm not saying that it'll happen. But anyway, their conclusion is that the big picture is more geopolitical reasons are more price driving in silver. So, what is our view on the silver price? Weighing the different scenarios, our view remains unchanged and positive, with silver prices expected to appreciate to US dollars 36.38 per ounce over 2025. They also go out of their way to say, because of this stuff in the pipeline, it's going to ebb and flow. I mean, it's the Trump effect, right? The price is going to be much more volatile. All right, moving to the next bank. Canadian Bullion Bank. Bullion in quotes because I don't know that they're actually officially a bullion bank, but they certainly know their metals better than most. All right. Direct commentary on the tariffs. Gold price implications long term are positive. Ultimately, an extended period of tariffs introduces higher inflation and slower global economic growth, both of which positively affect gold prices. Tariffs are stagflationary when it comes to natural resources that are not economically used. Next, silver price implications are less constructive. Silver is 50% of demand from industrial usage versus gold at 10%. Could see a large negative impact on its demand from key end markets impacted by tariffs, including solar power. It sounds bearish, but we're going to find out that the American Bullion Bank does not think it is. Now, this is a dry explanation. They also cover equities heavily. North American miners could face some degree of input cost pressures, while royalty companies could face benefit on a relative basis given their insulation from cost. Then the bank goes on to give names and numbers. Okay, so the tariffs are stagflationary. Okay, domestically they're inflationary. Globally they're recessionary. Right. So inflationary for us, and we slow down. So that's stagflationary for us, and just outright recessionary everywhere else. Let's go to the U.S. Bullion Bank, which gives a more nuanced, more thorough explanation. They actually share some numbers, which we think are very interesting. We shared them with a couple. Well, they're at the bottom. You'll see them at the bottom. President Trump has imposed a 25%, this came out on Sunday, I think, a 25% import tax on Canada and Mexico, 10% on energy imports from Canada, and a 10% levy on China to take effect from February 4th. Besides aluminum, I swear they're English. I mean American, but they're using aluminium there. And steel, we think the U.S. sufficiently reliant on imports of copper, gold, and silver from Canada and Mexico for this to drive meaningful further outperformance of U.S. versus X price metal pricing. Okay. Long and short of, if you're looking for bottom line, they're saying that U.S. prices, U.S. demand would not be significantly hurt in the metals, given the price increases they see coming from tariffs, and it would drive the price spread between the U.S. and the world wider. I think from there it would narrow from the other side coming in. All right. We see further tariff escalation as bullish for gold to $3,000 an ounce. They're reiterating their price. And silver to $36 an ounce, again, also reiterating, on a 6 to 12 month basis, and bearish copper to 8,500 a ton over the next 3 months on a ex-US price basis. You know, there's like our price and the world's price. Those stories continue at the bottom. We're going to discuss it more at length in premium. Moving on. News and analysis. There's Ross Norman's story. Watch everything you want to know about tariffs. Okay, it was short-lived, but there's some really good slides in there on the effects economically of tariffs. GoldFix PM, new all-time high in gold. That's our story. We're sticking with it. Michael Avery, special gold and silver tariff premiums that went out to founders yesterday. So we're discussing it now with you all. On deck, unemployment rate this week, and we have something else. We've got lots of PMIs this week. All right, final market check. I want to reiterate that this is, again, my opinion, this is about oil. Okay. Trump needs lower oil prices if he's going to, it's a key component of his plan to reindustrialize America, to reduce costs while reindustrializing, right? Fire government employees, get cheap oil, which will be drilled for, but it doesn't happen overnight. Uh, so he can't afford to have oil prices go up while this is happening because that's an uptick for inflation. And then all the senators and congressmen start getting nervous and say, oh, we can't abide by this idea, right? So he goes, tariffs, right? Everything drops. And our economy can handle it better than most, right? I mean, we have the global reserve currency to push back on any fiscal problems created by tariffs. They don't. So Mexico would cry uncle. They go into recession immediately. Canada would cry uncle, but not from a recessionary point of view. Uh, they have oil that we want. Uh, Europe, I'm not so sure how they cry uncle, but they would. Trump leaves room for people he's negotiating with. He comes out with a stick and the carrot is juicy. He gives them enough general room to get out of the problem. So, what do you have to do? We actually made a joke in a tweet the day before he uh, said they're negotiating, saying, well, we're going to remove the tariffs because Mexico is going to hire troops to police the border and to go after those evil cartels and stop the fentanyl coming from evil China. And Canada is going to, I don't know, do some. Oh, I think the joke I made about Canada was Canada is going to bring the Montreal Expos back. He gives the people he's attacking enough room to drive through because he needs and wants to declare victory on this, right? Even if it's not a big victory, it will be a big victory, I believe, over time. But even if it's not a big victory right away, he's got to close these deals because the final boss is China. It's a video game, right? You've got to solidify your home base, right? Even though in a mercantilistic world, it's very geographic, it's very protectionist. You've got to, and his style is to go stick first and then carrot later. And why did it end so quickly? Well, and because they capitulated. But you know, oil was higher. He doesn't want that. So publicly they capitulated. Privately, if oil wasn't higher, he would have said, "F you. I'm not going to stop the tariffs until you actually hire the troops." Okay. His good faith of bargaining is keeping an eye on oil. That's what happens. So if you look at the charts, right? Let's go to one chart there, so we don't get crazy. If you look at the charts, this is hourly, right? This is the tariffs, right? And this is the buying. And the tariffs basically said two things happened when the tariffs were implemented. Hot leverage money said, "Shit, I need these dollars so I can go and buy, food or whatever. Um, I need because dollar strength becomes a problem, and investors or not investors, speculators get out. And the big buyer, there is a big buyer, says, let's pull back and see what happens. They expected everything to drop, but oil didn't drop. So who knows? Gold, even more obvious, right? There you go. It's amazing. It's amazing. But the buying that we had going into the election has returned in full force. This is all MACD, folks. And it's not just American MACD. I think China's buying as well. This thing's going to 28.90, unless I'm wrong. And then from there, you can start talking about 3,000, 3,500, all those other things. But 28.90 is my level. And silver, 32, 33, who knows? But it'll get there in violent reactions. All right. I'm Vince. Have a great day. Stay with us, and we'll discuss